Warren Buffett said it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But what does it mean to buy a wonderful company? And is there a particular metric or group of metrics that we can use to define wonderful, or as most call it, quality companies? That's what research from October 2013 sought to answer. The paper is called Quality Minus Junk. In the paper, they create a composite of different metrics that define what a quality stock is, and they find that this particular composite of metrics significantly outperforms the market and does so with less risk. So in today's video, we're going to examine this research paper, and we'll look at how do we define what quality means, how do we measure what quality stocks are. I'll run my own backtest in Portfolio 123 to see if this metric still tests well. But before we get into that, a couple of announcements. The first of which, shout out to a company called Supernote. They sent me this digital e-ink planner. They didn't pay me anything. They just sent me this for free to try it out, take a look at it, and I absolutely love it. I'm actually using this little thing to screencast and record the screen and annotate. So far, I'm really loving this device, and hopefully I'll be able to share a little bit more about this device and how you, as an investor, can use it to improve your investment research. I'm not ready to do that yet. I'm still kind of getting familiar with the device, but just wanted to say thank you to Supernote for sending that out. And before we get started, just a reminder that I am not your investment advisor. This is not individual investment advice. It's just for education only. You should always do your own research before investing. Past performance does not indicate future results. So when we do a backtest, it doesn't necessarily mean that is going to repeat in the future. And finally, I think all the data is accurate, but I can't guarantee it. For my full terms of use, you can check out the link in the description down below. Also, for those of you who are in my Coffee Can Investing Club over on Patreon, the new Coffee Can scorecards are now available on Patreon as a PDF packet download. The Coffee Can scorecards will now include all of the data that you see in this video. So you can see this quality minus junk, and then we've got the different scores for each one of the metrics that we're going to talk about. So profitability score, growth score, safety score, and payout score, and then there's an overall score, which you can see here. And the scoring system, the star rating, is based on quality. So a 5-star stock is going to be the highest quality, and a 1-star stock is going to be the lowest quality. The entire S&P 500, at least the 400 or so that have all of this data, are now available on my Patreon page for the Coffee Can Investing Club. So if you're a member, you can check out this PDF packet right now. So the first question is, what do we mean by quality? There's a lot of different definitions for what quality means. In this paper, the researchers defined quality as meaning characteristics that investors should be willing to pay a higher price for, everything else equal. And they go on to talk about how high-quality stocks have historically presented a puzzle for efficient market hypothesis. If you get rewarded for risk, these stocks should generate below average returns. However, what they find is that they produce higher returns, not lower, which shouldn't make any sense. And the characteristics of a quality company are fourfold. They say a quality company should be, number 1, profitable, number 2, growing, number 3, safe, and number 4, payout, which we'll talk more about in a second. So what they did is they created a composite score that essentially equal weights all 4 of these components. And they used what's called a z-score, which is simply a statistical term to define how many standard deviations a particular metric is away from the mean. So for example, let's say the average stock had a return on invested capital of 10%, and let's say the standard deviation was 5%. So that means if a stock had a return on invested capital of 15, that would be 1 standard deviation above the mean. If they had 20% return on capital, that's 2 standard deviations from the mean. And on the other side, if they had a 5% return on capital, that is -1. If they had a 0% return on capital, that is -2. And then the average would be 0. So each one of these subcategories had some specific ratios that they used to measure each one of those. Under the profitability metric, they're looking at gross profits over assets. There's actually a research paper from 2013 by Novi Marks that I reviewed that used this metric, and it was an extremely impressive paper. This is now one of my favorite metrics to use. So they also use this metric here in this research paper. Return on equity and return on assets. If you watch this channel, you know that return on invested capital is personally my favorite metric to use, but these are both excellent as well. They also use cash flow on assets. Number 5, they use gross profit margins, which is measuring gross profits divided by revenue. And then finally, they look at accruals divided by earnings. The lower, the better. So the less a company is potentially manipulating its earnings, making its earnings appear higher than its cash flows suggest they should be, they will get penalized under this scoring system. Number 2, under growth, all the same metrics, you'll notice, because basically they're taking all of these same metrics and they're measuring the 5-year change. And what I really like about this is that instead of using the traditional methodology for growth, which most people think of as earnings per share growth or maybe sales growth, they're using growth in profitability. And I think that's the most accurate way to consider growth. For example, let's say that a company is going to invest, let's say, $100 million to build a new factory. And let's say this factory is going to generate profits of $1 million. So if we're just looking at earnings growth, you would say that this $1 million did increase their earnings. However, it required an investment of $100 million to do so, which means the return on investment was only 1%. So if this is a company that had a return on invested capital, or in this case, return on equity or assets of greater than 1%, then this new 1% investment on a factory is actually going to reduce all of these numbers and not show growth, which is exactly what we would want. Number 3, we have safety. Now, this is what I think most people think about when they think about quality. It's actually just safety. I personally prefer the first 2 measures, profitability and growth. But safety is also a component that they use. Most of these are market-driven metrics like low beta. I personally don't like using beta, but they used it for this paper. Low idiosyncratic volatility, which I had to look up the formula for how they figured this one. But basically, it's just low standard deviation. Using a fancy name for it is a little bit different than that, but for all intents and purposes, that's what it is. Low leverage, so low debt relative to assets. They also use the Altman Z-score, which is a measure of bankruptcy risk. Same thing for Olson's O-score. I do note here that I was not able to replicate the O-score, so I did not include that in my backtesting. And then finally, I really like this one, low return on equity volatility. So if you have a company that has very erratic earnings, ROE going all over the place, that will score worse than a company that has consistently high ROE. And the last measure of quality, I found this one pretty interesting. Essentially, this is shareholder yield in a nutshell. So they're looking at equity issuance, the lower the better, debt issuance, the lower the better, and then net payout over profits, the higher the better. So they're essentially saying that if a company is paying out a significant amount of their earnings as dividends or buybacks, that is a good thing. So 5 quick takeaways from this paper. Number 1, quality outperforms. This is the portfolio outperformance. If you would buy a portfolio of long securities that were high quality on this scoring system, so if they scored in the top 67th percentile or greater, they would be in the long portfolio. And then they shorted the stocks that were less than 33 percentile. So it's going long the highest quality stocks and shorting the lowest quality. And you can see that there are some lumps when this underperformed, but overall, this outperformed the broader market significantly by almost 3%. And this was measuring data from 1956 to 2012 using 36,000, I think, stocks. They also found this was consistent across different countries. So they studied 24 different countries, and they found that in 23 out of 24, quality outperformed junk, which does not make any sense because not only does quality increase returns, but it also reduces risk. The researchers found that there was a quality premium, so generally, stocks that were higher quality did trade for an above average price to earnings ratio. It just wasn't as high as it should have been. But they also found that that quality premium tended to increase, and the high points were typically in moments of crisis. So 1990 Gulf War, 2002 after the tech bubble pop and the Enron WorldCom accounting fraud, and then the 2009 financial crisis. In all of those periods, quality stocks premium were at the highest, meaning that when you had a crisis, these stocks tended to outperform, helping you hold up better in down markets. And this increases what I like to call stick-with-itness. And I think a strategy that's lower risk tends to help people stick with their stock portfolio in particular for as long as possible, which generally increases your returns. So if we look at just a simple chart here, let's say we've got probability of success here on the left side and time on the bottom axis. Generally, your probability of success investing in stocks will increase with time. So if you just want to make money in stocks for one day, for example, it's basically a coin flip, whether stocks are going to go up or not. If, on the other hand, you hold stocks for 10 years, the odds are probably 90% that you're going to be successful. And if you hold them for 20 years, there's basically never been a rolling 20-year period where stocks have lost money. Now, that's not every stock, it's the broad market index. So you can lose money investing in stocks over 20 years, but if you're investing in the broad market or a diversified portfolio of quality stocks, very low chance you're going to lose money after a multi-decade time period. And that's why quality stocks, I think, are the perfect coffee can complement. I'm a coffee can investor, meaning I'm buying and holding stocks for 10 plus years. And generally, a high profitable quality company is going to perform best over the course of 10 plus years. The researchers actually found that the companies that were listed as high quality in year one were very likely to also be high quality after 5 to 10 years. In other words, a quality company today is more likely than not to remain a quality company for a long time. And finally, number 5, they found that combining the quality scoring system with value actually performed better than both value investing and quality investing independently. This is really, I think, what Warren Buffett and Charlie Munger's strategy was. They didn't just buy value stocks, and they didn't just buy quality stocks, they bought value and quality together. And the researchers found that when they combined roughly 70% of the quality factor with 30% of a value factor, they used book to market value for that, that had the highest Sharpe ratio. So mostly looking at quality, but then adding some valuation was the best strategy in their estimation. And so that brings up the question, does this still work today? To find out, I used Portfolio 123, which is my favorite data provider and backtesting tool. I went back to 2005 and I backtested this composite. So let's hop over to Portfolio 123 and we will backtest this strategy. I'm going to go to universe and ranking. In this case, the starting universe, I used the S&P 500 index. I did use a ranking system, which is the quality minus junk composite. So what I'm doing is I'm buying the highest scoring 50 stocks and I'm starting each of them at a 2% weighting. And then from there, I am not putting in any sell rules. So this is going to buy the highest scoring 50. And then the only reason it's ever going to have to reinvest money is if we have a stock that gets acquired or something like that and cash enters the portfolio or has to reinvest dividends or whatever it's going to buy. Maybe a handful of stocks. For the period, I'm using 2005 to 2025, and I'm gonna run this simulation and we'll see what it shows. So here are the results. The model portfolio is in this red line. The blue line is the benchmark, the S&P 500, and we can see the stats here on the right. So it did result in some outperformance, total return 783 versus the S&P at 605. But importantly, it reduced the maximum drawdown from 0809 to 44% from 55 for the S&P 500. So this did significantly reduce the downside risk, which I think is probably the main benefit of something like this. Maybe it does outperform the market in the future, but it's probably going to reduce downside risk, which is why I think it's an excellent screening tool for most people. There is one little secret that I didn't tell you about, and that is I actually excluded one particular stock from this simulation, and that was NVIDIA. So you'll see here on the restrict buy list, I took NVIDIA out. So I didn't allow the simulation to buy NVIDIA. If we put NVIDIA back in, we allow it to buy NVIDIA, rerun the simulation, what you'll see is the returns are actually significantly better because NVIDIA was one of the first stocks that it chose. So I took it out at the beginning because I don't want you to get too carried away with this. Probably a unicorn that it bought a long time ago. And you can just see the power of buying it, really just one winner. So you invested 2% of the portfolio in NVIDIA and it ended up as a 41.3% weight had you never touched it. So this is kind of the coffee can ideal situation. You end up with a ridiculously high returning stock. You never trim it and it just becomes a massive part of your portfolio. So I don't want this to be the expectation that this is going to happen every single time, because it's definitely not. So does this work? I think we can confidently say that yes, it does work. And more importantly, it seems to work well with a coffee can methodology, which is why I'm planning to use this to do my Q1 2025 coffee can buys. So this is how I'm going to do it. I haven't done this yet. I haven't picked the stocks. I haven't even run the top 50 screener, but I'm planning to do this. So I'll make a video and probably post that next week. So what I'm going to do is I'm going to have the starting universe S&P 500, just like we did in this back test. I'm going to sort them by the top 50 quality minus junk scores. I'm going to run those, and then I'm going to pull up the coffee can scorecards. So if you're a Patreon member, you know what I'm talking about, but I'm going to look at all 50 of those coffee can scorecards, and I'm going to pick which ones I think look the best of those 50. So there'll be a little bit of quantitative involved and a little bit of subjective for my own. So not going to do in-depth research into these necessarily. I'm just going to kind of take a glance at the coffee can scores, pick the 30 out of 50 that I think look the best, and that will be my Q1 2025 coffee can portfolio that I will plan to hold until 2035. And we will see if that portfolio is able to outperform the S&P 500. If you're interested in more about coffee can investing and getting access to the PDFs, be sure to check out the Coffee Can Investing Club on Patreon. I'll put a link to that in the description down below. If you're an ultra long-term investor and you're interested in learning more about this particular strategy, you can check it out. I think there's a lot of valuable content there. Probably the biggest value would be these coffee can scorecards, which are all 500 stocks in the S&P and dividend aristocrats. There's over 150,000 data points, and it has data all the way back to 2001 for some stocks. You'll also get a bunch of exclusive videos and also 2 e-courses, one how to value stocks and the financial freedom formula. Both of those are free as my gift to you for signing up. Thank you to everyone who has. This is a huge way to support my channel and help me keep this YouTube channel content flowing. So thank you all very much for signing up and supporting my free content. Thanks for watching, and I will see you in the next video.